Do you want to know what the heck's going on in the market? Well, you're going to have to know a few things. I'm going to go over all of it right now in a very quick video to show you visually how you can tie macroeconomic policy events to price action in the chart on the major indexes and basically give you a summarization of what exactly is going on in the market. So it's a few things, right? There's actually a lot going on in the market, but a lot of people are not paying attention to the right areas as far as what's going on. As far as social media, things like that, it's kind of irrelevant. It is irrelevant to the markets. It's more of a distraction, in my opinion. So first, we must understand a few key facts before trying to break down the psychology of the current markets. We have to realize that price action equals the effect, and the cause is the decisions that are made outside of the system. You know, all the narratives you see in the media, Russia this, Russia that, energy, semiconductors, it's all related. Now, the markets are now globally interconnected, which has been a ongoing effort from the global community in finance for quite some time. It's clear as day that especially with the birth of crypto now, it's all one system at this point. Now, what's going on in the market? Well, let's think. This chart right here tells us the whole story. All we have to do is go back in time, starting from this area here, because again, if you look at the entirety of this chart, dating all the way back to before 2005, there has never been this much demand in the repo market, not even close. But there's a reason for all this. There is a reason for all this. Number one is the transition from LIBOR to SOFR. That started in 2018. As far as the backdating for data on that, they started doing that in 2018, and it was a daunting task. $400 trillion of products were affected, and the United States had exposure to over half of that. So keep that in mind. Now, the repo, all you need to think of it as is a place for banks and hedge funds and market participants to go and lend to each other cash for collateral. One side needs cash, one side needs collateral. They lend to each other for an interest rate. That's what they've been doing for the better part of the last year and in a month or so. So if you want to know what's going on, you just look at this chart and you box it off and you say, okay, well, when did the demand start for the on RRP facility for the Fed? It started in April of 2021 is when it really started taking off. Okay, so why is there a gap? There was no demand between March 30th, 2020 and April of 2021. There's a reason for all this. Number one is the supplemental leverage ratio monetary policy, which basically freed up capital for these big banks and institutions to allow them to buy up risky companies and risky assets. Next, just follow along with me. So just follow along. So this is 2019 in September. This is when it all started. The interfund lending market basically died during this time, Q2 of 2020. Now, what's the interfund lending market? Well, that is where banks lend to one another. So what happens if interest rates are, so low or so high that you can't get a good deal? Well, that's basically what was happening in 2019. The banks wanted, lower rates. They couldn't get the lower rates because the banks wouldn't lend to them for those rates, so they ran to the Fed, and the Fed began clearing for these big players to get those low rates that they wanted. During COVID, a lot of redemptions were happening in money market funds, which was very 2008-esque, so they did not want that situation to arise again. Now, also at this time, they started developing the SLR monetary policy around November of 2019, which again gave leverage to all these banks. On top of that, late March 2020, right when SLR was implemented, the SEC relaxes interfund loan rules during the crisis. So on top of this, the SEC basically made it, as of March 23rd, 2020, they allowed funds to lend to each other through their sisters' funds or through their sister funds, which is a big problem. I mean, they can lend literally to their own funds. That's why you see ETFs and ETFs and ETFs. They're all lending to one another because they're allowed to do so by the SEC in 2020. So all you have to do now is just knowing those things, the LIBOR transition, the fact that the reason why the repo demand didn't exist in 2020 was because there was no need for it, because they were able to leverage with the relief from monetary policy. So if we look at these lines right here, I'm going to go through these real quick. On September 17th, 2019 is when the Fed stepped in for central clearing. On March 31st, 2020 is when SLR was implemented, and by this time you had SEC relief as well. On 8/10, this is the line where it's relevant to China. China's three red lines policy started around this time, which was basically, if you think about this, between these two green lines right here, that is the SLR policy. Think of it as a leverage window. So at the same time that United States is leveraging, using this monetary policy to their advantage and the SEC relief, China, on the other hand, about halfway or third of the way through, starts forcibly deleveraging their major developers, real estate developers, and it's literally the opposite, yin yang, right? So this line here is when the repo ends, or when the repo starts and the SLR ends, supplemental leverage ratio, enacted by the Fed. And then this purple line here is when the Fed enacts their standing repo facility, creating effectively it's what's known as a corridor of monetary policy. The on RRP sets the floor, the standing repo sets the ceiling. It creates a corridor of monetary policy. Now they have their floor and their ceiling for their rates. Lastly, this red line here, this dotted one, is when this policy here from China expired. So 3 red lines expire in January of this year. And then the last 2 on the chart are purple and blue. This is coming up next week. This is when the Fed announces rate hikes. And this is when China potentially will be reopening their economy after COVID. So let's look at this mapped out a little bit better real quick. So this is when the interfund lending market died, basically. You see the big market sell-off right there. So right as the interfund lending market dies, the Fed steps in, starts lending, starts providing liquidity, gets the low rates that these banks need. Then, right after April 31st, after these policies are enacted, the markets start recovering. A lot of things hit their all-time high. Everyone quits their job to become a trader in 2020 because we're all making money because everything's going up because they're leveraging everything. So basically the Fed and the on-RRP replaces the interfund lending market, but not yet because we have SLR during this time. So next, and you all remember, you also had the SEC relief too. So these banks have freed up capital from SLR, and this is from 2020 to 2021, exactly 1 year from March 30th to April 30th, 2021. And then that's when the repo fires up to a T. Like as soon as that stuff expired is when the repo started going up to historic levels, and with it, inflation. And between here, again, this is when the 3 red lines policy from China starts in the middle of all that. So on one side you have deleveraging, and on the other side you have leveraging. And then we can look back to our repo chart at the beginning of all this, and now you see why it makes sense that we did not have demand from March 30th, 2020 to April 30th, 2020. It's because there was an SLR, monetary policy relief, enacted. No need for it. So this is where we're at so far. Now, when we get to here, this is when the Fed on RRP demand starts to surge, which is, again, all you need to think of it as is cash for collateral. It's a swap at a future date, share lending. This is the part where shares stop trading on the open market because they're all owned by these bank portfolios because they all had to be bought up. During this leverage period, they were all purchased up by BlackRock, Vanguard, all the major players. Go look at their portfolios. They're all holding 5, 6K positions. That's why. There's no shares on the secondary market. It's all through ETF creation, redemption, manipulation of supply and demand. And that's why they're controlling the markets through options right now as far as the secondary market. But that will change soon. This is all about to change when rate hikes begin. So, last but not least, China's 3 red policy is over. This happened January of this year. And guess what? Their government is ramping up liquidity. They're doing liquidity injections into the market. And they're going to start their leveraging cycle. So again, it's all cycles. They're tactically using sector rotation through a global chain now. And I think it may be the first time they're doing it, but maybe not. A lot of it is due to that SOFR changeover from LIBOR. So Fed rate hikes, this right here, last part. Fed rate hikes begin, and potentially COVID lockdowns end for China. We'll have to wait and see what happens. Next week's going to be interesting for sure. Oh, and the most interesting part is if you throw one thing over the top of all of this that I just talked about, it's the cherry on top of the ice cream sundae. It's called COVID-19, which is the last-ditch effort to get LIBOR transitioned to SOFR before all hell breaks loose. Because again, LIBOR is unsecured lending, SOFR is secured lending. So what are we waiting on from the NSCC? That's right, the Secured Financing Transaction Service to be completed that got refiled the other day. What also came out on July 4th, 2021? The net stable funding ratio. Stable, secure. It's all about security. And what else came out last year in July? Remember the Goldman Sachs rehypothecation Expiration account that was open? Remember, this is when Reddit was effective at finding good information. I remember, this was actually useful information. You see how far back I have to go to get this? 11 months. Ridiculous. Look, they even linked me in this. You see, I was popular. They call them on me to answer this question. That is hilarious. Well, in case I never answered your question. Oh, this is my video I made.
About 4 hours.
All right, I don't want to show you video in a video. This is the document here. So on June 14th, 2021, Goldman Sachs International Rehypothecation Separation Account was open in Europe. There's a reason why this was open in Europe. Is because they do not have the same leverage cap that we do over here in America. They have unlimited leverage basically over there. So it all comes together. It's all related to macroeconomic events. There is no retail effect. There is no we're going to beat Wall Street. It's they're controlling everything globally because the system is a global system. I mean, come on. Think about it. Everything here, one duck after another, it all lines up way too perfectly, and it's kind of interesting. It really is. It all ties in, cause and effect. But that explains why you see this shit right here. The reason why there's no buy, no sell volume, but there is neutral volume, is because they never traded any shares. It's only on display because they can't trade the shares. They need them for collateral. Because again, there's toxic assets in the system at historic levels, which has become cash, the US dollar. So I'm going to get this video published, and hopefully this rings some bells, because again, it all lines up. Go tie any macroeconomic events to the chart, and you will shit your pants at how much it lines up. So, alrighty, you have a good one.